is not suitable for all investors. Past performance is not necessarily indicative of future results. Starting from my home station today, so a mic check would be great. Let me know how I'm coming across. Um, let's dive right into it. Get into our conversion trading pre-market summary sheet this morning. The market posture is mixed to a slight tilt to risk on. We just had the U.S. PCE price index come across, and it was relatively strong, which is bearish. So at 7:30 Central, 8:30 Eastern, U.S. Core PCE price index year on year came in at 4.9%, 4.9% versus the expected 4.7%. The prior is 4.6, revised to 4.7. 1 second. And then the month on month came in at 0.6 for August versus 0.5 expected. So inflationary, right? So that's where we are. We have Fed's Brainerd releasing comments. If you recall, Fed's Brainerd really threw a wrench in things earlier in the summer. Fed's Vice Chair Brainerd says monetary policy will need to be restricted for some time to have confidence inflation moving back to 2%, is committed to avoiding pulling back prematurely. So with the Fed parade today, with what's happened overnight Japan's consumer confidence number came in at 30.8 versus 34. The Kaikshen manufacturing PMI out of China yesterday at 9:45 Eastern came in at 48.1 versus 49.8, also missed. The MBS manufacturing PMI came in relatively strong at 50.1 versus 49.8. And then this today, inflation out of France came in at 5.6%, 6.1 versus 6.1, so it's better, but the inflation number across the EU came in, the flash number year on year came in at 10% versus 9.7 expected. The unemployment rate came in at 6.6 versus 6.7%, so still relatively hot. The inflation rate month on month in Europe, 1.2% versus 1%. Again, and then we got U.S. personal spending this morning, which was relatively strong, 0.4% versus 0.2 expected, and personal income at 0.3% versus 0.2. Those two numbers, if there's more spending and more income, yada yada, so on and so forth, more inflation, more interest rate rises, and so on. So we have a bunch of Fed speakers right now. So I don't know, news, to me, a lot of people don't like to hear the news, but to me a news feed is really important, not because I want to trade the news. People think the news is distracting and you can't trade the news faster than the machines, but I'd like to know, I prefer to know what's being said, what's going on. It doesn't mean that I'll trade it, but also I get reminders from the news feed that something important is coming along, or there are rumors or whatever. So for me, since the day I started trading professionally about 22 years ago, I've always had a news feed. It is a key part of me staying current with what's going on. Today at 9:45 we get Chicago PMI. I want to remind you that Chicago PMI is a private number. It goes out to subscribers at 9:42. So the reaction really is around 9:42 a.m. versus the 9:45 when it goes public, expecting 52. Michigan consumer sentiment final for September at 10, expecting 59.5. And then we get Fed's Bowman, ECB Schnabel, and Fed's Williams after that. So it's just continuous Fed blabber. So that's where we are. So those are the things that are hot. China came in and moved to support its offshore its offshore yuan FX rate. The yuan has been falling uh, quite dramatically, and it has basically told the offshore banks to trade the Chinese yuan. Imagine if a government can do that, if the US government did that. It's telling these offshore banks to trade the yuan closer to the onshore rate or the official rate. So it's really trying to support its currency. You know, the currency falling is, of course, advantageous, especially if you're a producer, which China is. China is the world's um, manufacturing sector. It's our factories. Um, so the product becomes cheaper against the dollar, but it also means that there's a lot of inflation. There's a lot of inflation for the locals, right? It just makes it harder for people to consume grains and whatnot, which are imported to fulfill the demand. So they need to step in, and they are. Russia moves to annex 2 Ukrainian regions. Russia has made it clear. Putin has come out this morning and said that once he's warning Kiev that if they continue to push into these regions, these Russian regions, it's like almost infuriating. Not that I'm related to anyone who's Ukrainian, but still, it just seems like just bullying. Um, he's saying that they'll defend it with by all means necessary, which is something he's been saying. So they're going to finish the legislative part of annexing these regions. Um, NATO's Secretary General is expected to speak at 12 p.m. Eastern today. So that's going to be important. This is, of course, a threat to NATO, and having taken these regions, having shown that their forces aren't as strong as the propaganda says, the move right now is, what's to stop NATO from stepping in there and establishing a presence in Ukraine, as Ukraine has been wanting for years. So this is likely to get messier more so than getting better, which means there's a risk to Europe, there's a risk to energy prices, and of course there's that kind of assured mutual destruction part of the nuclear race. So this needs to be monitored, but it doesn't have an immediate impact on us. The S&P multi-distribution profile today, 475,000 contracts, so pretty heavy, relatively heavy volume again. 53.5 points in range, less than what we saw yesterday in the overnight session, but still quite heavy. Point of control at 36.65 in the S&P, slightly better than what we had yesterday, and the low at 36.40 and a quarter. So we're trading. The overnight session traded inside of yesterday's range. We took back some of the excess or the selling tail that was put into the S&P when we opened yesterday. We've taken some of that back, and we're battling in the region of 36.50, currently the mid-century figure. So this is where we stand. There's really not much I can add today here in terms of context. I mean, you look at this chart here. This is, again, the orange is the overnight, blue is the RTH, and we are basically sitting in this. What's going on here? That's interesting. We're basically sitting in this the low end of the range. We're not moving away from the low, which tells me that we have not found those buyers yet. So the S&P is not showing signs that it has found buyers temporarily. But one thing I want to kind of spend a second on is this chart here. You all know, hopefully you know what the U.S. yield curve is. There's the U.S. Treasury yield curve, and then there's the Eurodollar yield curve, and Eurodollars are dollars held outside of the US at foreign entities, and there's a yield curve for that, and that speaks to a much higher volume or a much higher presence than the US Treasury yield curve. But still, if you look at this yield curve, you'll see the top is at 4.2%. That's the 3-year, the 2-year, 3-year, really heavy. With it being inverted, it's kind of got a weird shape to it. It's not inverted in that normally an inversion is the short end is high, the long end is low, and that expresses much, much greater risk in the short run than in the long run. But what we have is the short end moving up with the Fed making adjustments. It's come up, from 0% to 2.8% here almost in one month, and you're we keep talking about, hey, these yields, you got to watch those yields, and I just want to give you an impression of what that looks like. So you see the 4.2 up top there. If I go a month ago, see it's at 3.6 and not even getting there, 3.5. A weird kink in the 20-year. If I go a month before that, so we still have this deformed yield curve, but the 20-year is heavy. But it's more of a shape that we can live with. If we go a month before that, you see it's much more normal. Okay, and so what's my point here? As we move forward, these yields have really driven the risk appetite for the market, and they will continue to do so. And as you can see, we have a lot of inversion between the 10-year and 2-year, 10-year, 3-year, the 5-year, 2-year, and so on. There's a lot of risk premium being injected into the yield curve, making it very expensive, especially for tech-heavy companies, to operate. And so this has been driving the Nasdaq lower, and some of the big players lower. And in the last couple days, if you look at how this thing has moved, you could see that yesterday it pushed higher. We sold off in the S&Ps. The day before was even higher. The 28th actually pulled back a little bit, gave us a little bit of a relief, and then the day before that was higher. And you can see that there's a pretty tight correlation between what's happening in the equities and their ability to sustain rallies versus what the yield curve is doing. I don't have one for the euro-dollar yield curve, but that shows more of a kind of a troubling shape. And so I want, for those of you who are not aware of how that works and so on, I'm not an expert on macro. This is something that I've been focusing on for the last 2 years and reading up a lot about. And we've had Jeff Snyder and others on Eric Townsend and so on convergent trading to speak to us about the repo market. It's ginormous, and what happened in the repo market to require the Fed to interject in 2018 and things like that. But if we're focused on price and volume on a daily basis, but I don't want us to have our heads too far in the sand. This is a key chart for me. This is the composite day session chart, and I'm just going to remove everything but the weekly profiles here, and this is how this thing is moving. You can see that the trend overall, lower peaks. When it does make a peak, it takes a few weeks to make a peak, and we are just not coming off of the low. To me, this looks an awful lot like it is likely to continue lower. I don't see an excess here. In the chart, and therefore with this week's point of control at 36.55, to me this looks a whole lot like it is a whole lot like it is not done on the downside. We're just not, we've built a pretty balanced week, really. We've got, let me see, let's make these invisible so you can see that the profile for this week is not as choppy as the week before. You can see the week before was pretty choppy, and we had a gap, and we finished near the lows. This week it's trying to make a turn here, but I can tell you that it's pretty unsuccessful at the moment. We did bounce yesterday off the low, but we bounced from 36.20 back to 36.58, and we're holding steady here at 36.50. So we're trading around yesterday's close. We're trading inside of the range in the overnight session, but we're not moving away from that low. And to me, it just doesn't seem like we don't have the type of action where we open, we have a really meaningful reversal, and we close at highs, especially if it's a neutral extreme up type day. So this thing, even though it rallied yesterday into the close, that rally is not an excess. If it's just sitting, it rallied right back to the mid of the session. So if we look at that, I know I'm getting into a lot of technical stuff here, but this is really important to understand. So this is yesterday here. We had a selling run. So we had a bit of a drive down. You could see the dramatic drop, 28.5 points drop here on this run here, and consolidation. So now we look for the continuation trade. Got the continuation trade against this collision right here at the 65. 65 showed us a bit of an iceberg that got supported from the downside from below, and then we got the continuation. Great. Here's a nice little pullback to the mid. We see pretty strong respect for day type levels, and we got a mid setup here, pushed back, and it finally pushed through. It looked like it was done. Higher low, so low, higher low, squeezes through the RTH VWAP, squeezes back into the prior range, pushes to the mid, pulls back, and to me this looks like another high low for a pushback, and I was expecting it maybe to break the IB high at this point, and it just had no interest to the buy side. And so we end up breaking down later in the session in the afternoon. We end up breaking down and breaking the IB, giving us the IB stat, higher low, and then all we did on that run that looked like an excess, like I don't see an excess on the profile here, all we did here is run back to the mid. We finished at the mid. We finished at the point of control at the mid. So yesterday was sort of a balanced day. Sort of a balanced day. It didn't speak to an excess. An excess really is a they just can't buy enough, right? So they can't get enough low enough prices, and you see it just climb, buy, pretty aggressive, and then that's when we have OTF action on the buy side. That's when we have accumulation, a market that is actually seeing these low prices as cheap and pushing through rather than pushing back to the mid and holding. That's not really meaningful. So this morning we open up where we closed, we pull back a little bit, higher low again, we push to this 93.75. But what have we done since? We've basically held sideways. It's a multi-distribution profile, but really it's a balanced profile. So we're currently holding below the overnight point of control, below the full session mid, full session VWAP. Those are right here, full session mid at 67, full session VWAP 65, the overnight point of control at 65, right here, 65 and a quarter, and we're holding steady. So I'm expecting a bit of a choppy open today, and it would take a fair amount of aggression for me to start looking at this and seeing that actually I should not be pushing the structured trade, should not be pushing the short side. So the last couple of days, Yesterday, for sure, just pushing the short side. The prior day was pushing the long side only, and this was really stretched. This looked like a reversal day to me. It took out the prior day's high, which took out the prior day's high, and to me it looked like, yes, we took out the high and went to the low, and then we took all of this back. We took this, what was it, Tuesday's action back. And to me, this looked like it's found a low, and it is likely to start driving towards this 3780 up here, close the gap, get the 3780, consolidate, form a base, and then would likely see ourselves way up here at the 3890. But no, yesterday comes in, it opens, and it drops right off. Yes, we have a higher low to the lowest low we've put in the overnight session, but overall, this is a bear flag type of formation. It's really moved to a low price, and we have accepted these low prices. We've basically shifted our value down, and to me, we should be rejecting these values if buyers were to come in, and if we don't reject them and we accept them, they become the norm, and then we continue to push lower. The old example here is, you know, if a loaf of bread or the price of a carton of milk was $6, and now the market's flooded and it's $3, it's on sale for $3, and there are stickers everywhere, and it's on sale, it's on sale, it's on sale. When you go to the supermarket, and you see that, hey, today's sale, the milk is at $3, what do you think? You think, no, that's not a sale anymore. That's the normal price. I buy my milk for $3, been doing it for the last 6 months. This is the new price for milk. You want to give me a sale? You want to get me to buy 2 cartons of milk? Offer it for $2, right? Then I'll grab that because it's a short-term edge. It's an excess price. It's an excess low price. And that's what's happening here with the S&P. We're accepting these lower prices because we're not shifting away and advertising higher prices and making it look to everybody like things are getting lifted. So to me, this in the long-ish term, to me, this looks like the market is not done going lower. Okay, so that's that whole spiel is just to tell you that. We are well below the 41.58. We are well below the 39.90, the 38.80, and we are just in this inverted cup and handle type of formation here. You know, just like down, tried, and we are here. And to me, this was the pivot. This 36.57 and a quarter. We're trading at 36.48. This was the pivot, and to me, this looks very ripe for a push below. So this area here was acceptance, but we are at the low end of that acceptance area. Okay, so just be aware of what the bigger picture is. Now, what do we got today? Today, looking at the relative delta, first of all, we are flat on the session. Look at that delta. We've made a nice little run up to the 93.75. The trade was controlled by both small and large lots, very large lots not participating in the overnight session, and we get the PCE causing a quick drop to 36.40 here, and then we have consolidated since the PCE. We're still trading the PCE range right here. This is the PCE bar range, 74 to 40.75, 74.75 to 40.75. We've been trading that range ever since, and now we're starting to scoot down with delta moving down. So to me, this looks weak. It looks like we're likely to continue lower. It is the end of month today. It's the end of quarter today. We start Q4 tomorrow or Monday, and we start our earnings season. In the meantime, we're getting companies starting to announce some layoffs. Facebook's one of those. RBC is laying off a bunch of people and so on. But the Fed does not see enough of an indication of job losses and a reduction in pressure on wages. And so I think this rate increase cycle continues, and as a result, it makes earnings on the S&P lower. And remember, 40% of the S&P earn in foreign currency. So 40% of the dollars generated by the S&P in terms of revenue are now likely to be impacted by a US dollar that is historically high. That's being factored into this as well. So this earnings season in Q4 is going to be just tremendous. It's going to be very hot. It's going to be very hot, and it's going to be very volatile. So make sure that you're around for that to see how this historical action is taking place. What am I expecting for today? Real quick, because I've rambled. Man, it is really hard not to go on and on and on, because there's a lot going on here. So it's hard for me to just not say anything. So what am I looking at here? Open auction. We're inside of the prior range here. So we have an excess at the high. I expect that we are likely to try higher. I'm expecting an impulse down, and I'm expecting this thing to push and squeeze and push and squeeze lower. I'm looking for this thing to really give up yesterday's low. I'm not expecting a bounce today. Okay, so that's what I'm looking at. To me, probably the door gets closed around 36.70, 71 this morning. The 70.71 is likely to close the door on the buyers, and then we give up the overnight low. It's already weak, and that leaves us with the 36.37, and then from there it's the overnight low 36.20, and then the target becomes 13 down below. That's the key scenario for today. And then the other scenario is an open auction that pushes lower, takes out the overnight low, gets an impulse back to the mid, consolidates, squeezes into the 70 area, maybe slushes a little bit more, but overall just an inside day and holding steady. At the close today, be careful on the closing range, meaning the last 20 minutes or so when the market on close imbalances come in, there are likely to be some pretty strong movements today since it's Q3, the end of Q3. There's a lot of window dressing that's going to take place today. So be cautious. Don't leave orders just sitting out there, okay? Good luck, and I'll catch you on Monday. Take care.
From a statement, India raises natural gas prices for October